Hello everyone, Mike Adams here, Stream Realty Partners. We are here for another Adams Insights. Today we are going to talk about everything commercial real estate financing. We're really going to talk about four things. First and foremost, we are going to talk about loan types. We're going to talk about loan qualifications. We're going to talk about interest rates and amortization terms, as well as financing. So first and foremost, loan types. Three different loan types that we're going to talk about today. First and foremost is the traditional bank loan. Typically, you'll have lower interest rates. The underwriting will be a little bit more stringent, but that's probably the most basic type of loan that you'll see. Next are SBA, Small Business Administration and Government Entity or government-backed loans. These are typically known as 504 or 7A loans. These are for owner-occupied loans, and you can put as little as 10% equity into these deals. And then there are more of your non-traditional financing structures, private and or bridge debt. These are shorter term, higher interest rate transactions. Really, people with a clear exit will use these. So somebody that needs quick money for an acquisition and or somebody that needs some money for a recapitalization and or redoing their improvements. Are you looking to invest in Orange County commercial real estate? We've been leading investors for over 15 years. We have over $600 million of transaction volume in 665 transactions. Whether you're a seasoned investor looking to add to your portfolio or an investor looking to better your cash flow position, we're here to help. Shoot us a text at the number above and we'll sure to get back to you soon. Second, loan qualifications. First and foremost, there's something called a DSCR, debt service coverage ratio. This is the property's ability to cover its debt. Typically, you'll see lenders will want a 1.2 to a 1.5 in order to finance a deal. Next, loan to value ratio. So this is the percentage of the loan in comparison to the actual purchase price. So typically in commercial deals, you'll see borrowers put anywhere from 20 to 35% into deals. And obviously credit will go into anybody's loan qualifications. So the borrower's liquidity, the borrower's track record, and the borrower's balance sheet will all come into play. Really the track record is really important. So if you're buying Orange County office, the lender will want to see a track record of you executing on Orange County office. Next, we're going to talk about interest rates. There's really two different types of interest rates. You've got fixed interest rates, which is very structured, non-changing interest rates. And these are mostly for long-term holders, very limited risk on those. And then you've got the variable interest rates, which in a declining interest rate environment, those are great. But in an interest rate environment, like we've seen the last couple of years where interest rates are starting to increase and have increased dramatically, those can be very risky and very challenging. Lastly, we're going to talk about financing structures or financing strategies. The first one we're going to talk about is seller financing. Seller financing is exactly what it says. It's the seller financing the borrower. It can be quicker than a typical bank, and it can also be more flexible. With that becomes some risks, but it's definitely something that can help for the right individual. There's other creative strategies such as mezz debt, and or pref equity. Pref equity is something that we're seeing a lot, kind of call it in the office world today. I would say another thing to keep in mind is refinancing, right? So that's another creative financing structure. That's when a borrower has seen appreciation. They go and they pull out the equity, and they use that equity for either new acquisitions and or improving their property. And lastly, all real estate comes down to really market fundamentals and understanding that vacancy rates, cap rates, and even really investor sentiment or office or product type sentiment will go into the lender's ability and desire to cut you the best deal possible.